Today, for the Series 6 exam, we will cover the 3 types of investment companies. Understanding this foundational concept is crucial because almost every investment company question builds upon this classification. The entire framework for these products comes from the Investment Company Act of 1940, which is a piece of legislation you must know. The Act officially defines 3 types of investment companies: face amount certificate companies, unit investment trusts, and management companies. The core purpose of any investment company is to pool money from many investors, allowing them to achieve diversification and professional management that would be difficult to obtain on their own. Each of the 3 types accomplishes this pooling function in a very distinct way. Let's begin with the most unusual type, the face amount certificate. You are unlikely to see this product in the modern market, but its definition is still testable. A face amount certificate is a security that promises to pay an investor a fixed sum of money, its face amount, at a specific future date. In return, the investor pays a lump sum or makes periodic payments. Think of it like a debt instrument. An exam question might describe a scenario where a client agrees to pay $500 a year for 10 years to receive a guaranteed $20,000 at the end of the term. It will then ask you to identify the investment company structure. The key is the promise of a fixed, predetermined future sum, which is the defining feature of a face amount certificate. Next are unit investment trusts, commonly known as UITs. The most important characteristic of a UIT to remember for the exam is that its portfolio is fixed and not actively managed. A sponsor assembles a portfolio of securities, such as municipal bonds or dividend-paying stocks, and places them in a trust. Once this portfolio is created, it is not changed. There is no portfolio manager buying and selling securities. Instead, a trustee oversees the trust's operation and the collection of income, but does not make investment decisions. UITs are also created with a planned liquidation date. On this date, the securities in the portfolio are sold, and the proceeds are distributed to the unit holders. A common exam trap is to confuse the trustee's supervisory role with active management. The test will ask to identify an investment company that is passively managed or has a static portfolio, and the correct answer is always the UIT. The third and most common type is the management investment company. This is the broad category that includes mutual funds and closed-end funds. Unlike a UIT, a management company's portfolio is dynamic and actively managed. It has a board of directors to represent the shareholders' interests and hires an investment advisor to manage the portfolio on a daily basis. This investment advisor is paid an annual management fee to constantly research, buy, and sell securities to try and achieve the fund's stated objective. The exam will heavily test your knowledge of the 2 subtypes, open-end and closed-end funds, in other sections. For this introduction, the critical distinction is the presence of an active investment advisor making portfolio decisions. To keep these 3 types straight, remember the simple phrase, managers make moves, UITs are unchanging, and a face amount is a fixed payout. The Series 6 exam loves to test the distinctions between these structures. They might ask which investment company does not have a board of directors, which would be the UIT, or they might ask which company employs an investment advisor, which is the management company. By remembering these core differences, you will build a strong foundation for all other investment company topics.